Mr. Naif, who is new to the world of financial markets, has a huge question mark on what is secondary market. Now, before we dive into what is secondary market, let's know what is a financial market. Financial market is what which facilitates the interaction between those who need capital and those who have capital to invest. The financial markets are divided into two types: the money market, which involve financial instruments with maturities less than 1 year, and capital markets, which involve financial instruments with maturities more than 1 year. The capital markets are in turn divided into two types. The primary market deals with issue of new securities, and the secondary market, which deals with the trade of existing securities. Secondary market is nothing but stock market and is also known as stock exchange. It allows buyers and sellers of securities to meet, interact and transact. The market allows for price discovery and provides liquidity and marketability of existing investments in a secure and a regulated environment. Examples are National Stock Exchange of India, New York Stock Exchange, Nasdaq, etc. The securities included are either equity shares, ETFs or closed-ended funds. Apart from stocks, secondary market also involves trading of mutual funds and bonds by investment banks and other investors. The prices here are determined by forces of demand and supply. When majority of investors think that stock value increases, they rush to buy it, and as a result, the stock price increases and vice versa. Secondary market is primarily of two types. The first one is the over-the-counter or the OTC market. Markets are decentralized space where investors trade amongst themselves. In such markets, there is a very fierce competition to get higher volumes, which leads to a difference in prices from one seller to another. Compared with exchanges, the risk is higher as the seller and buyer deal on a one-to-one basis. The foreign exchange market is an example of OTC markets. The second one is exchanges. In the secondary market, there is not a direct contact between the seller and buyer of the security. To make trading safe and secure, heavy regulations are in place. Counterparty risk in this case is almost zero as exchanges are the guarantees. There is a comparatively high transaction cost because of the exchange fees and commission. Now, who are the participants in the secondary market? The secondary market has the following participants. Number 1, members of exchange, that is stockbrokers. Number 2, ultimate borrowers, that is corporate sector. Number 3, financial intermediaries. Number 4, ultimate lenders. Number 5, fund managers. Number 6, speculators and arbitrators.
Stock exchange serves as an economic barometer that is indicative of the states of economy. It records all the major and minor changes in the share prices. It is rightly said to be the pulse of the economy, which reflects the state of economy. Stock exchange offers a platform for trading of securities of the various companies. This process of trading involves continuous disinvestment and investment, which offers opportunities for capital formation and subsequently growth of the economy. In addition, exchange also provides liquidity, as it is relatively easy to sell one's holdings. By providing liquidity and real-time price information on the company's shares, the stock exchange also encourages an efficient market by allowing investors to actively decide the value of companies through supply and demand. Founded in 1602, the Amsterdam Stock Exchange is generally considered to be the oldest and still operating stock exchange in the world. The history of stock market in India goes back to the end of 18th century when long-term negotiable securities was first issued. In 1850, the Companies Act was issued for the first time, bringing with it the feature of limited liability and generating investors' interest in corporate securities. The first stock exchange in India was set up in 1875 as a native share and stockbroker association in Bombay. In present times, we call it as Bombay Stock Exchange.
The stock market timings all over the country are from 9:15 am to 3:30 pm and are also called as continuous trading hours, preceded by a pre-opening session that is from 9 am to 9:15 am. It is divided into 3 slots. In first 8 minutes, one can place orders to buy or sell securities in the market. The next 3 minutes are for price matching actions involving determining of demand and supply and helps arrive at a final price. The last 3 minutes connect the pre-opening session to the continuous trading hours. Coming to the post-closing session, it is divided into 2 slots, that is 3:30 pm to 3:40 pm, that is the first slot. The closing price of stocks are calculated by taking the weighted average price of stock prices traded between 3 pm to 3:30 pm. The later 20 minutes, 3:40 pm to 4 pm, buy and sell orders can still be placed but are confirmed only if there are sufficient number of buyers and sellers in the market.
The share market is extremely volatile as there are numerous factors affecting the value of shares like government policies, budget, sectoral events, company disclosures, change in management of the company, etc. Apart from this, markets are susceptible to rolling effect, which means when a famous investor such as Warren Buffett invest or disinvest from a company, the effect is manifold and smaller investors follow them, leading to either exponential rise in the prices or huge decline in the price. The other demerit of exchange market is investors going for impulsive investment. The impulsive investments are investments purely based on one's impulses or hearsay. These investments are not on research that are likely to result in losses for the investors.
The Indian capital markets are efficiently regulated and tracked by the Securities Exchange Board of India, the RBI, and the Ministry of Finance. Ministry of Finance operates via Department of Economic Affairs. This division works to safeguard the interests of traders and investors trading in the stock market of India. SEBI, established under SEBI Act of 1992, is a primarily authorized regulatory body that regulates Indian stock exchanges. The key function of SEBI is to keep the interest of investors and traders protected. By protecting the interests of traders and investors, SEBI thereby promotes fairness in stock exchange, promotes investor learning opportunities, and manages complaints division. SEBI has been responsible for taking several steps to ensure the seamless operation of stock markets in India. To name an instance is to abolish insider trading, one of the main loopholes of stock market that gave certain traders an unfair advantage.